question here from Shivam, and this is a good one because it's sort of a bigger picture question, but it's one that we get from time to time and talk a lot about because it's not fully, you can't fully make sense of it. But Shivam asks, I have a general question. Why do stocks go down after earnings? Is it the institution pumping and dumping at the same time and taking profits out of the next trading day? Are they trying to create a fear of missing out? For example, Apple beat their earnings, Amazon beat their earnings. Uh, yeah, I mean, Matt, we see this from time to time. I mean, a company drops a great quarterly report, the numbers are all just kind of mind blowing, and then you see the stock going down the next day. And there can sometimes be an explanation for that, and sometimes not. Um, I don't know. What do you think?
Yeah, and I mean that's a really tough thing to generalize. A lot of times, you really have to dig into a company's earnings report to figure out why it's going up or down. Um, like Amex was a great example that we just talked about. The stock went down after earnings, even though on the surface it looked great, but their revenue was kind of light. The CEO gave some comments about how travel and entertainment were still pretty weak.
Yeah.
There's the bottom line is there's literally hundreds of different factors that can move a stock after earnings. There's a lot in
Yeah.
it. So I look at earnings. If a stock goes down after earnings and I don't see anything really wrong with the report from a long term investor's perspective, I tend to think of it as a buying opportunity. Um, you know, when Amex went down after earnings, I thought that was a buying opportunity.
Yeah.
Um, whenever any of my favorite stocks um, miss and go down afterwards, or better or better yet, have a great report and go down. I think Apple popped right after earnings, but immediately took a nosedive.
You buy
Uh,
the dip.
right, definitely buy the dip if
Yeah.
if nothing has changed from a long term perspective.
Yeah.
If revenue guidance was if the market was expecting 50 billion in revenue next year and they guide for 49.5 and the stock goes down,
Yeah.
that's a buying opportunity.
Yeah. Yeah.
So
Yeah. I mean, it's just investing is about the future, right? And I mean, you've got any little thing in a call where analysts or investors can nitpick and say, well, this next quarter or this next year, this company is going to be spending more than we thought they were going to be spending, and margins are going to be impacted by this. And I mean, that's genuinely that short term versus long term um, approach, right? I mean, that's the difference between the two, and it's not always easy to spot, to explain, or to rationalize. But that's why we invest the way that we do, because typically when you're talking about good businesses, I mean, one quarter doesn't make or break a good business. And oftentimes, even if a business is going to say, for example, that they're going to be investing a lot, over the course of the next year, if that investment is meant to bolster sustainable and meaningful top line growth, well, that investment eventually will stop. You'll be able to realize, more on the bottom line when that investment stops. But if it results in that sustainable and meaningful top line growth, well, then usually it's going to be worth it, assuming they're able to pull back on that investment and realize those savings down to the bottom line. So it's just a matter of taking that longer view. If you can hold that patience. Yeah, I mean, Apple and Amazon, two very good examples there. In that, I mean, having gone through both of those quarters, I mean, I'll be the first to tell you they were stellar. I mean, by virtually every measure. Um, but you take into consideration the fact that they're coming off of some crazy comparables here with the past year. You got Jeff Bezos, for example. He's going into what, his last quarter, I think, as CEO of the business. Um, Apple, are they going to realize the same iPhone tailwinds that they realized this past? I mean, just all sorts of questions that are brought in to play for shorter term investors, which don't necessarily bother us as much. So that's why we focus on the business and not the after hours reactions, because they're two very different things.